In this week's video, we'll review the latest charts and data to help us understand why recession forecasts are getting pushed out again, opening the door to a year-end stock rally. These are the major topics that we'll be covering to help us assess the probability of good things happening relative to the probability of bad things happening. Let's start with some scary headlines from this week. October 3rd, 10-year Treasury yield hits 4.8%, a 16-year high. With a headline like that, the market must have broken key support levels. With a headline like that, some may find it surprising that the S&P 500 finished the week up 20 points and the VIX was down this week. You may remember we said back on August 18th and numerous times since that it wouldn't be shocking to see the S&P 500 retrace to this level, these levels, and even this level down here. Concerns would increase fairly significantly if we breach this level here. Chart on your screen is dated August 16th. Thus far, our closing drawdown is right in the support band that we've been talking about, the lowest low. 7.83% is that drawdown between this number and these numbers here. Thus, we really haven't seen anything yet that significantly damages the base case. Back to the headlines from this week. If we're willing to answer objectively to stronger than expected GDP growth, latest forecast puts third quarter GDP at 4.9%, to stronger than expected NFP data, which is indicative of a strong labor market, and do higher interest rates align with or contradict the concept of a demographically driven secular bull market and an environment that may produce extremely disappointing returns for balanced fund investors in the years ahead? Markets have been volatile. It's been a difficult environment. Given the price of a 30-year bond has tumbled 53%, it puts some of that difficulty into perspective. The headline on your screen aligns with this chart and aligns with these concepts. And as we've discussed in the past, rising interest rates doesn't necessarily mean the stock market can't rise. Long-term interest rates between 1950 and into the 1970s on your screen. And we know from past videos, one of the strongest periods of this secular bull market was between 1950 and the end of 1968, in an environment with rising interest rates. And common sense tells us if the economy is still growing at a very respectable clip, and the economy is still adding jobs at a very respectable clip, it wouldn't be shocking if third quarter earnings come in better than expected. And if that's the case, in the context of a still strong economy and a still strong labor market, and in the context of a stock market that has a retracement that thus far doesn't seem to really do any damage to that base case, we at least have to keep an open mind about the possibility of a much stronger than expected stock rally over the next 3 months. We've covered this slide many times. Top of the slide. Bullish trends occur when market participants interpret all of the fundamental data in a manner that is favorable for future economic outcomes. Volatility is never fun. However, on Thursday of this week, this chart is dated Thursday, October 5th. The S&P 500 remained above an upward sloping 200-day moving average and remained above and had recently made a stand at an upward sloping 200-week moving average, both indicative of bullish trends. And common sense tells us that one of the first recession dominoes to fall is people begin to lose their jobs. This is the headline from October 6th. Thus, the headlines don't seem to be veering off course or contradicting the notion of a long-term uptrend in the stock market, which means as we go through the rest of the data and charts in this week's video, we should ask ourselves, do they align with or contradict the bullet points that we covered back on September 1st? Including that the coming months could be volatile with a bias to the upside, and that most likely tolerating swings would add add value relative to trying to overtrade in an environment with quite a bit of interest rate-induced volatility. It's now several weeks later, and it's probably fair to say, over the past several weeks, inflation and interest rates have caused big swings in the stock market. And as we review the rest of the charts, let's keep this in mind. Is it reasonable to still try to navigate to the right side of the table? It's possible we're in here, and our goal is to get out here to the right side of the table. We've made a lot of progress in the development of the secular trend volatility model, and the charts that follow speak to some of the concepts utilized in that model. Probably fair to say that the secular trend on the lower left-hand portion of your screen looks quite a bit different relative to the period of secular stagnation in the center of your screen, and the period of secular stagnation looks significantly different relative to the 2012 to 2023 window. Thus, when the markets are volatile, we want to have some secular trend reference points. Remember, we said the strongest portion of this secular trend occurred between 1950 and the end of 1968. You can see in that window the S&P 500 held above the 70-month moving average the entire time. When the markets were extremely volatile this week, this is October 3rd, price remained well above an upward sloping 70-month in green. In the 1982 to 2000 window, price held above the 45-month moving average for the entire move from point A down here to point B in the upper right-hand corner of your screen. How does the exact same chart with the exact same moving average look today? Made a stand near the 45-month at the COVID low, made a stand in October of 2022, and during the volatility in October of 2023, price remains above an upward sloping 45-month moving average in green. So we just looked at the 70-month and the 45-month. If we put both of those MAs on a current chart, you can see in the present-day secular trend window, price has made a stand at or near those secular trend reference points. And on October 4th, we were above the 70-month, the 45-month, and the 55-month. And the 55-month works well for the current move, and the 55-month falls right in between the 45-month and the 70-month. Nothing magical about any of this. It simply serves as a secular trend reference point. Similar situation in the 1950 to 1968 window. In the stronger portions of the trend, price makes a stand at the 225-week, that's the dotted moving average here. And when things get a little bit more dicey within the context of the secular trend, price tended to make a stand above an upward sloping 410-week moving average. If we look at the exact same moving averages when the S&P 500 was down 38 points during the trading session on October 4th, we don't see anything that seems to contradict the secular trend thesis. Similar concepts, S&P 500 1982 to 2002, during the secular trend 1982 to 2000, high-low closed bars. Price, when the trend is strong, tends to hold above the 125-week moving average, the dotted line. And even during the larger drawdowns, it tends to make a stand above the 230-week moving average. S&P 500 peaks in March of the year 2000, and you can see that's no longer the case. Can't hold it, it rolls over. Can't hold it, it starts to roll over. You're testing the exact same moving average during October 4th session. S&P 500 at the time was down 48 points for the week. We finished up 20 points for the week. Thus far, it's held. We remain well above the thick moving average shown in the bottom portion of the price and moving average stack. In the current secular trend window, prices tended to make a stand above the 235-week moving average, during the larger drawdowns above the 425-week moving average. If we look at all of these secular trend reference points as of the close on October 4th, when the S&P was down 24 points for the week, it's difficult to look at the chart and say that the secular trend thesis, in terms of price, is in serious doubt. And when the market was volatile on October 5th, It's a lot easier to try to be patient when the S&P 500 is above the 200-day. The slope of the 200-day is rising. The 20-week is above the 30-week. The 30-week is above the 40-week. The slope of the 50-week is positive. Price is above the 200-week. The slope of the 200-week is positive. Price is above the 50-month, and the slope of the 50-month is positive. This speaks to the longer-term primary trend. And all of this aligns with, rather than contradicts, this. And all of this aligns with this period, and this period, and doesn't fit well with this orange box, or this orange box. And all of this aligns nicely with this. And as we noted 6 weeks before the correction began, filling gaps, givebacks, and volatility, 100% normal and to be expected. Now, if we fast forward to the first week in October, all of these bullet points still apply, except it's still not fair to say that trends remain constructive on all time frames. The bulls still have some work to do, some significant work to do in terms of recapturing the shorter term trends. As always, the commentary is based on the charts in front of us, and this look here and this look here align with this concept up here. Thus, it might be logical to ask and answer this question: is the market possibly misreading the economic tea leaves? As we've stated in the past, these are the major data sets that are used to determine whether or not the U.S. economy is expanding or contracting. Said another way, these are the data sets that are used to determine whether or not we're in an economic recession. For the most part, every other economic data set is used to try to predict what's going to happen with these data sets. Thus, it's logical to examine the data sets directly and to try to understand what type of deterioration we typically see during an economic recession. Real personal income excluding current transfer receipts. Typically, there is noticeable deterioration during recessions. True in the dot-com bust, and very easy to see even from across the room during the financial crisis. Data took a big hit during the COVID recession, and in 2023, it's sitting at an all-time high. This really doesn't look anything like this. Similar concepts with non-farm payrolls in the 40s, 50s, 60s, and 70s. And even during the double dip in the 1980s, we see a common theme that carried into 1990, the dot-com bust, and the financial crisis. During recessions, people tend to lose their jobs. How does the exact same data set look today? Economy continues to add jobs. This is 2023 over here. But that could change at any time. Yes, that's true. And that was true 6 months ago. That was true 18 months ago. And that's why it's important to take it day by day with an open mind. The National Bureau of Economic Research doesn't just rely on non-farm payrolls. It also looks at something known as the household survey. And not surprisingly, during recessions, we typically see weakness in the household survey. Double dip in the 80s, the long-awaited recession after the 1987 crash. Data sets started to deteriorate. It was visible. A lot of job losses in the financial crisis. And during the pandemic, exact same data set today has been moving from the lower left to the upper right, as opposed to the upper left to the lower right. And this is a 1-year look at the more traditional measure of employment, total non-farm payrolls. Real personal consumption expenditures don't have a lot of data here, but once again you can see the deterioration. We can also see that the recent trend has been moving from the lower left to the upper right. This really doesn't look anything like this. Similar concepts, visible weakness in real manufacturing and trade industry sales. S&P 500 experiences a big drawdown in this window. Fairly obvious during the double dip. 1990-91. .com. financial crisis, COVID. If we go back to last summer, the recent trend for the most part has been from the lower left to the upper right. Not wildly strong, but far from a look like this. There's a lot of industrial production data that we can look at all the way back to the 1920s and 30s. Clear deterioration during a very big drawdown in the S&P 500 in this window, and this window. Once again, upper left to lower right. Upper left, lower right, upper left, lower right, COVID, upper left, plunge to the lower right, present day. Recent trend has been moving from the lower left to the upper right. And somewhat similar to the present day. 2022, we had a very large drawdown. 1987, there was a very large drawdown. In the wake of the 1987 crash and in the wake of the 2022 bear market, there is a lot of fear relative to a recession. And with interest rates rising rapidly in the present day, October of 2023, there's still a lot of talk about the possibility of a recession in the next 18 months. But remember, we said there was a lot of fear about a recession in the wake of the 1987 crash, and that fear was still around in April of 1989 when the S&P 500's chart, the monthly chart, looked like this. And as we've covered in the past, we had a very similar look in July of this year. So what happened when there was a ton of fear still lingering about a recession in April of 1989? And we know, by the way, that a recession is coming in 1990. Was it prudent to sit on the sidelines in April of 1989 because you were fearful of a recession? Here's April of 1989. The S&P 500 tacked on an additional 18.85%. The NASDAQ 100 gained over 20%, an additional 20+%. All of that occurred before the recession window. And from a longer-term perspective, the recession did not derail the secular trend. Now, history tells us that we don't want to get overly concerned about recessions, because there were 5 recessions that occurred within the context of a secular trend. Since we're using a weight of the evidence approach, let's look at some additional charts to see what we can learn. Sentiment for now is holding this uptrend that was established off of the September-October window in 2022. You can pause your video player here. If you know your stock market history, you know here in 1973 into October of 1974, you really didn't want to be in the stock market in that window. Same can be said for 2008 here. A lot of drawdowns associated with this indicator getting down into this area here. On October 4th, we're up here. For now, this looks like a bullish breakout followed by a period of consolidation. This too looks like a constructive turn on the weekly chart followed by a period of consolidation. October 6th, in this case at 2:18 p.m. Eastern Time. For now, trying to make a stand near a logical level with an upward sloping 200-day moving average down here and a gap here and a gap here. Even if good things are going to happen longer term, it wouldn't be shocking at all if price decided to come down into this window here. That's to be determined. Let's look at the weekly chart here before the close on Thursday the 5th. This is the same chart at 2:19 p.m. on the 6th. Trying to make a stand near a logical level, making a stand above an upward sloping 200-week moving average. All of that occurring from an oversold condition with MACD well above the zero line. Still have the constructive long-term look in the Copic curve. This really doesn't look anything like this. This is the October low from last year. This is Friday, October 6th at 2:23 p.m. Eastern Time. Trying to make a stand near an upward sloping 200-week. The bears still control the short-term trend, and breadth still needs to improve. probably fair to say if we're going to experience a debt crisis, a major debt crisis, that the S&P 500 financial sector will not hold this area of support. Chart dated October 6th. S&P 1500 as of the close on Thursday, October 5th, trying to make a stand near a logical area. This is a weekly chart. Also a logical area near a gap on the daily chart and an upward sloping 200-day moving average in blue. Thursday's session was better at 2:27 p.m. Eastern Time. The weekly outcome flipped from red to green. These are the looks that we want to avoid. This is the look on October 6th. This really doesn't look like any of this. S&P 500 daily as of the close on Thursday with a look like this and all of this potential support in here. Volatility is never fun, but it's relatively easy to be patient when all of this is occurring above an upward sloping 200-day moving average shown in orange here, shown in red down here, and as of the close on Thursday, October 5th, we were still in the vicinity of this gap that we've talked about numerous times. We went below the gap on Friday morning and then closed back above this gap and above an upward sloping 200-day. A lot of reference points on the screen, all of these charts dated October 5th, which is Thursday. If we look at this chart objectively at 2:10 p.m. on October 6th, it supports a patient approach. It's a VIX chart that we've talked about numerous times. What once acted as support may now act as resistance. This is as of Thursday's close. It's the same chart at 2:36 p.m. on October 6th. As noted earlier, the VIX did finish red for the week. More about this chart here and more about potential support in this short takes post. You can find it by Googling the title on your screen. And remember we said earlier that the drawdown in the S&P 500 was approximately 8% thus far in October of 2023. Thus, we wanted to know, during these very large drawdown windows in which the average drawdown was 27% and the median drawdown was 19.8%, when the market fell from this peak on this date and it fell 7.83%, which is what we've experienced thus far, we wanted to know where was the VIX, because the VIX should tell you something about the expectation that this number is going to get much larger, as it did in every one of these cases. Answer: average reading 31.65, median just a little bit over 31. During Friday's session, we're at 17.4. This is a lot lower than this, and the VIX speaks to volatility expectations. If volatility returns, the VIX could shoot all the way up to 26, and you would still be below this downward sloping trend line where price held in March of 2023. Not a prediction in any shape, form, or fashion. Bond ETFs have been extremely weak, but IEF still has not clearly violated this October low from 2022. This is what extreme economic fear looks like. This is what the same chart looked like as of Thursday's close. This is the same chart as of October 6th at 3:24 p.m. Eastern Time. This really doesn't look anything like this. If you know your stock market history, you know the stock market bottomed here early in 2016, and there was a fairly significant drawdown in this window here. You can see this ratio starts to fall well before the stock market peaks in May of 2015. So this is your risk off look here in the credit markets. This is the bullish breakout that we experienced in 2023. And this is the look of the chart on October 6th at 3:24 p.m. Eastern. Ratio well above an upward sloping 200-week moving average. Quite a bit different relative to this look and this look. Things were looking dicey as of the close on Thursday, October 5th for the broader market. IYW, as of Thursday's close, was green for the week. still checking all of the bullish boxes on the weekly cloud, telling us that this is being classified as a counter trend move within the context of an existing and ongoing weekly uptrend. IYW rallied with the market on Friday. This is 3:30 p.m. The ETF was up 3.23% for the week. Like the NASDAQ, wouldn't be shocking if price came back to this gap here and an upward sloping 200-day. We don't want to make any assumptions about what's going to happen next week. Here's that same bearish window that we just talked about in the S&P 500 bottoms down here in early 2016. Notice the ratio is below a downward sloping 200-day moving average in green. In the present day, we are still above an upward sloping 200-day moving average in green. It's easier to be patient during a drawdown when QQQ is above an upward sloping 200-day, upward sloping 225-day, upward sloping 250-day, and upward sloping 300-day, all of which speak to a longer-term uptrend. Why are a lot of these charts dated Thursday? Because they were pulled Thursday, and there was really no need to update them on Friday because they were pulled because they said things just don't look that bad yet. S&P 500 relative to defensive-oriented XLP staples in the ETF world. The ratio slashes through a flattening 50-month moving average, and the 50-month moving average rolls over in 2008 during the high fear period in the financial crisis. This is the S&P 500 down here. This, price below a downward sloping 50-month, really doesn't look anything like the chart as of Thursday's close. The ratio was up 1.92% for the week and above an upward sloping 50-month moving average in blue. And if we flip the ratio upside down, this is XLP divided by SPY. Defensive staples during Friday's session were underperforming SPY for the full week by 3.7%. This doesn't look like fear, and this doesn't look like fear. This is what financial conditions look like, and this is not a good look for financial conditions based on this metric during the 1973-74 bear market. Double dip recession in the 1980s, well above the zero line during the 1990 recession, and a big spike above the zero line during the financial crisis. When you're below the center line, financial conditions are looser or easier relative to average or normal conditions. It's one measure of credit spreads, really nothing particularly spiky yet. We have seen a little bit of a turn up, but if we draw a horizontal line, it's not particularly alarming at this point. Another way to look at credit spreads, BAA corporate bonds relative to the yield on a 10-year treasury. This is what increasing fear looks like in the financial crisis. This is what increasing economic fear or fear of defaults looks like during the COVID recession. This is what increasing fear looks like between 2000 and 2002 when the S&P 500 loses approximately 50% of its value and the NASDAQ gets annihilated. This is what the recent trend looks like. Things have been really, really volatile in the bond market. This chart is dated October 4th. With rapidly rising interest rates, we are not making any assumptions. All of the commentary in this week's video is based on the charts in front of us today. If people aren't losing their jobs, it's very difficult to envision a severe recession, especially an imminent severe recession. And if people aren't losing their jobs and we're not in a recession, then it's very, very difficult to envision a massive and catastrophic hit to corporate earnings. And if we don't get a massive and catastrophic hit to corporate earnings and we avoid a recession, it's very, very difficult to understand why we would get a 30 or 40% drawdown in the S&P 500. The concept of trading the chart in front of you speaks to maximum flexibility and not making any assumptions about any topic on any time frame. The charts continue to support the secular trend thesis. The demographics haven't changed. And the 1989 to 1990 window tells us we don't want to be overly concerned about the timing relative to a recession that could occur in the next 18 months. In the 1990 window, the S&P 500 gained 18% approximately. The Nasdaq tacked on an additional 20%. 3 years is a long time to be worried about a recession between the 1987 window and the 1990-1991 window. And we all know, if we're going to use all of this in an effective manner, it's extremely important that we head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shivako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.